The Rebel Capitalist Show.
So, Jim, I know that you're a historian, a financial historian, so I want to try to tap into your wisdom and experience. For many, me included, it seems like we're living in unprecedented times, not just with COVID, but now with what's going on with Russia, Ukraine. I know history doesn't repeat, but it rhymes. So what time frame in American history does what we're living through right now rhyme with?
Yeah. Well, of course, nothing is, few things are ever really literally new under the sun. The Spanish flu epidemic just after World War I certainly was much more lethal than today's version, COVID. As for the monetary stuff, that might in fact come close to being a singularity where we are. We notoriously had a paper money regime in the early days of the Republic, and it was in reaction and indeed revulsion against that the founders instituted something they thought would ensure a species standard, gold or silver, years ahead. But I think never have we seen the overlay of raging inflation and 0%, now getting a little wonky, but a 0% federal funds rate. And now we were speaking, so-called quantitative easing, QE, is still going. It's kind of winding down. But in the face of a pretty severe inflation, the Fed has set its little tiny policy interest rate at nil and continues to buy securities with money that didn't exist before the Fed tapped keys on a computer pad to call those dollar bills into existence. So in the monetary regime, we call it here at Grants the PhD standard, which is the more or less unbridled management of our monetary affairs by former tenured faculty members at our leading universities. It's kind of a new thing.
Do you think it's similar to the 1940s? Because
it's similar a little bit in that between 1942 and 1951, the Fed instituted what we would now call yield curve controls. It pegged, that was the verb, it pegged rates of interest along the curve, short to long. The bill rate was 0.375%. The long bond was something like 2.25, 2.5. Rates more or less where they are today. The bill rate, of course, 0.375% is towering over what we have seen in the past 10 years. But at that time there was, at least nominally, an anchor on the value of the dollar. It was defined as 1/35th of an ounce of gold. Now, during World War II, there was no action so far as foreign central banks, which had the right to exchange their green paper for bullion at that rate, $35 to the ounce. All of that, the mechanics of the gold standard were in suspense. So the gold standard was really in the deep freeze. It did not function. You could see that played out in the immense expansion of indebtedness in this country to finance World War II. So that was a kind of a flyaway debt regime with very low interest rates and financial repression, as it's now called,
and huge inflation.
Yeah, a huge inflation that was masked through price controls. But after controls came off, of course, that inflation came to the fore in the data. In 1946 and 47, I guess especially, we saw inflation in double digits, and the bond still trading at 2.25. So that bears some resemblance to what we have today. But that was in the teeth of World War II. That was a rather different geopolitical proposition than COVID.
Yeah, well,
pretext, the reason for the current round of monetary action and intervention.
Yeah. I hope it's not something that we'll see in the future with what's happening in Russia. We'll keep our fingers crossed there that cooler heads prevail.